What is up, Denver? Chris Lopez here, and today's podcast, we're going to talk about trends and deals in the commercial real estate market. Now, with the world shifting, the market shifting, rates doing what they're doing, inflation coming down, talking about what's currently going on and talking about deals is what I find most interesting. I think most of our listeners do as well. So today, we're very lucky to have Adam Aluise in the studio today. Adam is a commercial real estate professional. He's a local investor, development work, and his profession is a commercial lender with about 15 years experience. So we're going to hear about Adam's background. I've got a huge list of questions about the commercial market as to what's going to happen. We've fallen off a cliff. We're going to see a wave of distressed sales from arms resetting. So lots of fun stuff to talk about. Good morning, Adam. I'm excited.
Good morning to you. How's it going?
Very good.
Yeah.
I'm excited about this. We've chatted a few times and always go on like, hey, pause, let's save this for the podcast. So I got a lot of topics here for you, but let's just kind of give some quick background on who you are and exactly what you do for context here in the podcast. So you're in the commercial real estate space. Rewind a little bit. How'd you get into it and what do you do currently?
I got into commercial banking, real estate more than anything else, just because I thought it was going to be great and cool to wear a suit and have a briefcase. For whatever reason, that like resonated with me. So out of college, I got a management trainee position at a large top 5 bank, learned underwriting. They were a lot bigger than what was comfortable to me, but I got a great training. I don't even know if they offer that anymore. And then tried to find something a little bit more that like fit my personality. So something a little bit smaller here in town with a bank that actually is no longer around. They've been acquired a couple different times, but I was hired into the commercial real estate underwriting team. Mm-hmm. So outside of that, I mean, that's the only real reason that I started focusing on commercial real estate was because I was looking for a job after working for a huge conglomerate company and they hired me.
Yep.
Right. And so I did a lot of the underwriting work. So stuff between like $1 million and $50 million, every property type, whether it be, retail, multifamily.
And were these Colorado assets?
They were Colorado assets and regional.
Okay.
Right. So, I mean, but the way that you start is like you'll do, some reviews for some stuff in town, and then you'll do some renewals and then some originations. And then, depending on how good you get or how much experience you have, then they'll, let you kind of go a little bit there. And so worked as an underwriter, commercial real estate underwriter for a few years, leveraged that into origination. So, calling people like you and your team like, hey, would you like, love to put some debt financing together for you. Did that for 7 to 10 years, kind of had a stint after like 5 or 6 years, but that's a completely different conversation because that just talks about, having different relationships, right? And how that kind of just morphs into weird things. So I originated debt for 10 years after the underwriting. It was a great gig, right? You get golden handcuffs to some extent where, you make just enough to have a great living, kids in private school, stay at home, wife, like the whole thing. And then started through that journey, probably the last 3 or 4 years in the corporate environment where did some smaller scale development work, right? So I'm sure you've seen it all over town, right? But you buy 2 or 3 different lots, knock them down, go vertical.
Standard infill development, right?
Standard, right? And just kind of stamping that. And I found more fulfillment and creativity with that. I had a lot of different friends that had been, just making a killing, like doing really well for themselves. And I like to believe like I had some sort of input, right, to their success. And so, but it's different when, you kind of squirrel away your pennies and then you put it on the line. But it was so much more fun than kind of just the corporate thing, you know what I mean? And so prior to starting Pine and Peak, I mean, I had kind of been going through even just this change in what I wanted to be and who I actually was because, and I don't know if you've had this experience, but mine had been, if you earn a certain amount of financial resources or you hit a big house, or you have nice cars, your kids are in private school, like with that comes some sort of like fulfillment or happiness. Nobody told me that. That was not the case for me. And so once you get those things that you think are going to give you that happiness that don't come through, you're like, whoa.
Oh, I know exactly what you mean. It's just you reach the end of the video game level.
Right.
Now you need the next level of the video game to go out there and do the next, beat the next villain.
Yeah.
So you started Pine and Peak how many years ago?
3.
3 years ago. Okay. So that's your commercial lending operation.
Yep.
And I know you've got on your own on there. I want to really pivot and talk about deals and trends because, like I said, I am brimming with questions to kind of learn about this. So just kind of give us, we're recording this towards the end of January for context. We're 2 weeks away from next, I think, Fed meeting and whatever the rate hikes will come.
Yep.
Just give us a quick synopsis right now as to what you're seeing on trend-wise in the commercial real estate market, from what you find most interesting, debt perspective, what's going on in the market, just the current state of the market from your perspective as a commercial expert.
Yeah. And so, I think it's come a couple different ways, but from the debt perspective and then also from like a transactional buy-sell perspective, probably starting halfway, not even halfway, 3/4 the way through 2022, things came to a stop.
When did you feel it? Like, what was the approximate time
When did
frame?
I feel it? So I looked back at some deals that we had provided the debt placement with, and we were probably at the high 4s. And then you look in October, and then we're talking about like 7. Talking to different lenders, and so we were finishing up some deals that we had locked in, which were nice. Because we have various lenders that will rate lock without a charge, which is nice. But the 350 basis points like spread on pricing completely shut down the transactional side if you didn't have stuff in the pipeline. And you were constantly calling, people, what are you working on? What kind of things you got going on? And they were like, I can't make these deals pencil anymore, right? I don't know what's going on with the market, that volatility, and the Fed continues to meet, and then it's 50, 75 basis points. The whole market continues to go up, and it was by design. But from real estate perspective, you have to hit specific hurdles like return characteristics for an investment or group, number one, or yourself. So the transactional side and all asset types, specifically multifamily, really, really slowed like a ton.
And summertime, because I remember I remember it was like the second week of May or third week of May of this last year now, on the Envision Advisors residential side, it was just like all of a sudden, in the market, just the showings, the activity was like that second week or third week of May was like, boom, whoa, we just hit,
right. What happened?
Hit a brick wall.
Right.
Yeah. It was very interesting.
So, probably about, you may be right, halfway through the year.
All right,
but not even until like the third quarter, we didn't see. We were still doing some deals with the pipeline, right? And we were at like 4, 4.5. You get to like 5.5. You can still make deals work, but every time that the Fed met, so it pulled back.
Okay, so with this, what's kind of like the forecast you expect this year? 2023, 2024, whatever it takes to shake out in terms of general activity in the commercial space. And I've talked to a couple people recently that were very bearish, kind of calling a 20% price decline from probably the peaks about, early last year. Or I'm kind of curious what your thoughts going forward, how that looks out, because you're right. Deals are not penciling like they used to.
Right.
Cheap money is over. And now when cheap money is over, investment fundamentals become a lot more important. And it takes more of the art for operators, investors to put deals together. So what are you thinking for this year? Kind of what's your crystal ball over there telling you?
Well, okay. So, but number one, as far as saying cheap debt, if we're talking about cheap debt, 5 to 6%, I would still say it's pretty cheap, right? It's not free money. It's not 3.25, 3.5 type of stuff, but all things considered, it's cheap money. The cap rates is what's, sellers and buyers aren't on the same page. But from the debt market perspective, when, what are we going to see, right? So depending on the smart person, the economist that you talk to, end of January, beginning of March, are they going to be an increase in the overnight? Yes. 50 basis points, 25 basis points. I think 25. I think we were talking, maybe you're thinking 50 or somebody told you 50. Then we'll probably have a pause probably for the most part of the
50,
year.
Just for,
right?
Just 50. For public record.
Okay, there we go. Well, I'm going to put you out there like that. You know what I'm saying? So a pause and then a potential, rate starting to drop a little bit more at the end of the year. The thing about it is, if you're talking about the overnight rate and of how it's going to affect the debt market, like the treasuries or the FHLB, it should be built into the yield curve, right? So you really shouldn't see a ton of increase in rates that way.
Well, let me. I want to ask you from a different perspective, because obviously rates have a huge impact on debt service coverage ratio, which impacts loan amounts, LTVs. So since rates go up, and since commercial real estate is definitely much more investment driven, are we going to see a massive price decline or asset value between making adjustable for rates because NOI is not getting huge faster. Right. Rent increases have slowed down dramatically across all asset classes, or at least most of them that I know of. And so we're going to see cap rates go up and prices go down.
Yeah. So, I mean, what do you consider massive?
I would say 20% would be massive in my book. So
I think 20% is massive.
Yeah. So from whatever the peak, I'm assuming last year is going to be kind of the peak of the price.
Sure. Yeah.
And we'll kind of probably go down, be flat for a bit.
Yeah.
I would say 20% would be massive.
20% is massive for sure. I mean, I think,
and I'm not expecting them. As curious.
No, right. I'm like maybe 5, in the worst case scenario, 10%. You know what I mean?
As a general
correction,
statement
as a general statement, probably
across commercial asset classes.
Right. Commercial and multifamily.
Okay.
Right. I mean, there's obviously going to be the rents that you're getting. I mean, people are still trying to figure that out. There's still so many things that are going on, right? Are we going to be able to get like the underwriting? Like, can you get the rents push like you thought you were supposed to on some value add, type of stuff? 10% I think is going to be the max what we would see as a kind of a correction.
Nationwide, Denver, Colorado. I'm gonna take that broad
more,
stroke.
So Colorado is going to be more insulated, right, for various reasons. I think we're probably more like 5%. But I mean, if you go to Nebraska, maybe that's 10%. I mean, they're just completely different markets.
Yeah, that's right. I'm very curious about here.
Colorado, we're more insulated, so I think the max we get is
What's the submarine water insulated? I mean, is that just simple, just the population?
Say that again.
Why is Colorado more insulated? Is that just inventory?
So there's still, Colorado is a very desirable place to live, right? And when I think like even COVID with things like that, people there's still a lot of in-migration.
Yeah.
Right. If you talk to different builders, their backlogs are full. If you look around, you see cranes all over the place. Right. The
cranes all over the place. I saw cranes all over the Miami skyline 15 years ago.
Yeah, but that's more like that. But that's boom or bust, right?
Yeah, but I'm saying this. So yeah, just to clarify here.
Sure. But there's actual job creation coming here. For whatever reason, become more of like a tech, hub or like a logistics company. So there's real job creation here. You know what I mean? And we're putting up new developments all the time. So we're able to absorb. And
so it's coming down to fundamentals. Population growth, job growth is still going to be the ultimate
I would say yes.
Okay. And I think we have a huge backlog in inventory, right?
Right.
Yeah.
So those team with all things is going to slow a little bit. Everybody's having a plus probably, but I mean, it's not going to be.
What about office buildings?
I think office building. I think that the market is still trying to figure out office buildings as a whole. Right. I mean, it's difficult though, because it's like this hybrid thing. Right. I mean, it seems like a good idea. You kind of can cut some costs and maybe save some money there, but you're also trading culture, right? I mean, as we're in here right now, you couldn't be doing the same thing probably as well, in your basement by yourself with, your whole team here separate. I think there's a lot
want my
to
dogs
say.
And kids running around too?
Of course. The more the merrier. That's right. Yeah, exactly.
Yeah. So I agree with you there. So I feel like commercial would be maybe take the biggest punch. I should say office space. Office space.
Yeah. And I mean, we talk to lenders all the time, at least 40 a week. And it's always, hey, what's your credit appetite? What where you guys have for pricing? What's kind of some terms, some different structure? And it doesn't matter who it is. There's a handful that will do some office that is super low leverage, but a lot of them are we really don't have an appetite for office.
When you say low leverage, quantify that, please.
So, I mean, from a commercial real estate professional perspective, I mean, just basic math, you're going to want to leverage things up as high as you can, just because the return characteristic is more. So, lower leverage, probably 60% would probably be a max. 60% loan to value on your office property, to really get a good look and really get some good terms. There's some other trying to think of the best way.
No, there's
alternative financing that will do more. But I mean, from a credit union, from a bank,
you're talking
from a life insurance company, right?
Exactly.
Yeah. I mean, we're talking 60% probably feels good. You just can't get them to pencil. Anyway.
What are you seeing in terms just basic leverage characteristics for multifamily?
So multifamily at its best, when things were 3.25, was 80%.
Yep.
Right. I think 65% is where we live now. I mean, depending on where you find it, and it's going to be hard to identify.
And that's still
65% just makes sense because you've got to back it into the debt service coverage ratio.
It still comes down to
size.
1.2, 1.3 DSCR.
Mm-hmm.
Okay.
Mm-hmm. And that will help you size it. Right.
Okay.
And you're asking now if you have a value add, property, will the lender lend on pro forma?
So rather than seeing a huge price decline, You're thinking that we'll see more of a modest price decline, but it'll be more about rather than prices dropping, the next wave of buyers just bringing more money to the table to close, right?
Yep, that's right.
Okay. So not a huge drop off or probably a huge swing in cap rates.
No, not a huge swing. It's just, it's people getting used to like the new return characteristic, right? I mean, we're making a lot of money for a long time, right? And those were great times. Now it's, it's just going to shrink a little bit, right? And you have to be okay with that because that's the market that we're in. So if you're waiting for this, 40% IRR,
how would you characterize the change in return? Like you just mentioned, I didn't hear what you said. What IRR were you mentioning? Kind of just a broad...
I was using like an extreme example, but I mean, typically, and I ask people all the time, I mean, what is your, return scenario? Like what do you need to invest $1 into a deal? And so, starting from 5 years ago, it was like nothing less than 20. And it was like about 20. I was like, oh, we're getting down to like an 18 IRR. And now it's kind of like teens. People are happy with like the
like
teens.
mid-low teens?
Mid to low teens, I think makes a lot of sense. And it's just where we are. I mean, I haven't seen a lot of deals that have a return that's a lot higher than that. I mean, there's always going to be a diamond in the rough and you invest in those people. But
I agree. That means.
Yeah. This is kind of where we are, which is good, right?
And so with those returns, people are going as they're forecasting just, because we used to have very, lofty pro forma rent increases.
Yeah.
I'm assuming people's pro forma underwriting has come down. So I'm like, if people are buying a deal, kind of what's the general underwriting for rent increases now? Is it 0%, 2%, or is like
it depends on who you're talking to, right? I mean, we've got some people that are trying to get deals done that, I mean, so I'm not talking about the best way. So I mean, there's still people that are saying, for multifamily specifically, annual 10% rent increases. Right. And there's some people that can make some argument for that. I don't necessarily
like just market or like value.
Just market.
Oh, okay.
Market. I mean, because of what's the appreciation over the past 10 years, what's it been? Year over year for, I think it's been like between 8 and 10%.
It's been right around 10%.
Right.
Yeah.
So, I mean, they're still saying, okay, we'll have a expense escalator of 3%, 4%, 5%, and then a bump in rents at like 10%. I think that's aggressive.
Yeah.
Right. I think that's massively aggressive, but the thing about pro formas is you can manipulate the numbers anywhere you want to get the deal done.
Yeah,
it's
but
like, can you actually execute?
When you go talk to banks and say, I got this deal, I want to put this together, like and I know all banks are different, like, are they coming back with like, hey, and now our underwriting is more like, hey, we're forecasting at 2%, 3%. Like, what are the people that give us money saying or forecasting?
Because
I don't believe in 10%.
You just go like, I think you just go like rule of thumb. I think you go 3% annual income escalators, 2 and 3% inflation. I mean, what are we at? 8 right now. So, I mean, I would just say people need to stay disciplined. I mean, there's going to be deals here in the short term. If you can kind of hold back a little bit and not jump the gun, there's going to be plenty of deals to be done. But
so let's talk about doing deals here, because I want to talk about some recent transactions you've done on the lending side. Mm-hmm. And one of the things I'm curious about, and there's been lots of just chatter about, is commercial loans are usually a 2 to 7 year ARM, a little longer, a little bit lower, but 2 to 7 years. As these ARMs start coming due, interest rates are going from 3.5% to now 6-7%. Mm-hmm. It's not uncommon now, or it's not unlike some investors have to bring additional cash to the table to help close a loan. Mm-hmm. Is that going to cause a wave of distress sales? That'd be the equivalent to like distress sales and commercial.
For sure. Yeah. No, I mean, there is going to be a lot of that, right? I mean, for the non-sophisticated, and that's not necessarily the word non-sophisticated, but people are trying to get in the market all the time. And over the past 3 or 4 or 5 years, it was a great time to get in, right? I mean, you can lever this thing all the way up. It's 3.25. Nobody knew that interest rates were going to, explode the way that they have been, right? And so from lenders of all kind, outside of, kind of life insurance or some CMBS stuff, you have to, there's annual covenants. Like you have a 1.25 debt service coverage ratio, like you have to hit, right? If not, then, lenders are being audited all the time and regulators are coming in. And so, you come in there, your deal is at a 1.25, at 3.25. Right now it's at 7%. They're going to ask you, it's a cash in refinance. It's like, they'd say, hey, Chris, you need to.
Could you give me like an example of maybe a deal you've seen where, hey, I was at, 1.25 3 years ago. I'm going to reset this year. at, kind of current numbers and current rates, is that showing like a 1.4, a 1.8 coverage ratio to 7%? I'm a little
So say that again. So
I'm just saying, just kind of, I actually want to quantify just an example you're saying here. So if I was at, a 1.25 debt coverage ratio 3 years ago, my loan term is coming up due this year.
Right.
Kind of just with what you've seen, and now at 7% with numbers where they've been the last 3 or 4 years. Am I still at a 1.25? Now I'm at 1.5, 1.6.
So
just like a broad stroke.
Right. So if you were saying we were coming in, we'll use like a value add property as like an example, right? Like I bought it at X. I'm going to put $20,000, $30,000 in the door. It's going to help me push up the rents to X. NOI is going to increase, and you're lending on the pro forma, right, of what it's going to be in the past. And so, you can get that number. Usually I would see between like 1.35 and 1.4 times what you had bought it at.
Okay.
Right. And then, you're hoping for those annual increases as well, right? Which you're typically getting in some of the markets here in Colorado for certain. But when your debt payments double, it's hard for you to get market appreciation and cash flow appreciation to escape that.
Oh yeah.
Right. And so you were pro forming at 1.35, 1.4 when you had, when you're the current like environment after you've added the value. Now it's going to get you down to like a one times, right? You are covering your debt payments with no money out. There's no cash on cash at all. Right. And so lenders say, well, you still need to get up to that 1.25. So we got to pay that loan down. So we'll do like a cash in refinance. I don't know if they'll give any more amortization depending on who you are. Right. But that's where the pain begins, because they're going to give,
Yeah. No, thank you for going, because I misspoke. I gave a higher. I meant to give a lower.
I know what you meant.
Okay.
Yeah.
No,
it's like DTI. Yeah.
So it's dropping, which means you have to bring. So you're seeing a lot of times, hey, it's going from like a 1.25 to like a 1.1.
1-to-1. Right.
Wow. Okay.
Right. This is typically what it's going to be. And then, so it's, like I said, you pay it down. You got to pay $250,000 down and get you within that little window at 1.25. If not, the lender will be nice enough to give you 60 days to figure it out.
Before they start the foreclosure process?
Oh, no. Well, see, this is what you need to understand too. At least it's been in my experience with lenders. Nobody wants to foreclose. Yeah. Like that is the absolute last thing they want to do.
And they're probably still hungover from 2008,
For
right?
sure. But they'll just make your life hell until you can move it. Right? Nobody wants those debt collectors. Nobody wants those calls. So it's going to be find a new relationship, find a lender that's going 1-to-1. Good luck with that. 2, what it's going to be is got to sell the asset, right? And so there'll be a lot of stuff. The transaction will start picking up a little bit when some of that is brought back out.
What percent? And I know this is a very hard question, but I want to give some try to quantify it some. So what percent of the overall market, 100% out there, is going to be affected by the debt resetting at a higher rate, and they're forced to sell because they have to bring cash? Is that 2%, 5%, 20% of the market? Do you have any way to kind of just do a broad estimate?
There is no, I can't even estimate. I have no.
I mean, it's going to be do you think it'll be massive? Like, oh my gosh, it's going to be like.
No, I mean, there's going to be, not, we're making extreme examples. There's not a lot of people, levered all the way up, right? I mean, there's some people that have seen some markets, and some cycles up and down. And so, they're like 65, 70, where, maybe the reset gets them to that 125 because they were clipping 1.8. It's just, the people that got a little greedy, just reached a little bit. You know what I mean?
What about, do you think, and this is, I doing a lot of work with Bigger Pockets and the Multifamily Mentors show. I've talked to a lot of operators and syndicators out there. Yeah. And I've talked to a lot that are, very experienced and sophisticated. Yeah. And they're navigating the market. I also talked to a lot where they were brand new young guns out there, hey, I dropped out of college to go raise money, and they're making a killing. And there's definitely, a big difference in experience on there, and also capital that they could bring to make a deal happen.
Sure.
Are a lot of syndicators going to get caught upside down in a max leverage and experience in that kind of scenario, do you think?
Yep. No, call their investor base and need a capital call.
And you think a lot will be able to do a capital call versus a forced sale?
Depends how much you believe in the asset. Sometimes it's time to get out, and sometimes it's we just got to weather the storm. Okay. So, I mean, is it fully... is there any vacancy, right? What asset class is? If it's office, I don't know. If it's multifamily, it's
I think
you know.
I think multifamily. I mean, that's been
Well, I guess that's
that's
what you
been
were saying.
the
yeah.
yeah, that's been the very hot thing the last handful of years, at least in my space.
It's not going to be as bad as I thought about 6 months ago.
So your sentiment has changed.
I think my sentiment has changed, and I think the debt markets are thawing a little bit.
So 6 months ago, you're like, oh shit.
6 months ago, I was like, oh shit,
we're going to see it 20%.
Oh, no question. I was
Okay.
like, things were pricing out and talking to various lenders, 4.5%, and then you go and down the road, and you're like, I'm getting quotes like 7.5%, 8%. Like that's absurd, and like there was no stop. I mean, everybody reads the same things, right? I mean, depending on, we didn't know how long it was going to go before it got better. Kind of fourth quarter, everybody changed their tune a little bit. Inflation was coming down rather than 75 or 50 basis points like bumps that they were talking about. Said like 50, 25, right? It started to come down a little bit. Market started to settle just a little bit. So that teamed with talking to different, real estate professionals and different like transactional brokers. There's more things coming online, right? Are those deals getting done right now? Not all of them, but there's people that are, dipping their toe back in the game. Okay, what does this look like? What kind of debt can I get on this? What kind of return can I get on this? And so
you've seen it pick up.
I've seen it pick up, exactly. Have those deals closed yet? No,
but that's the leading indicator,
right? Exactly. It's thawing a little bit, and I'm seeing
what are
more
the. I mean, obviously, you work with a lot of brokers. Commercial brokers. Are they kind of the same sentiment or seeing the same interest, early indicator interest pick up as well?
They are a little bit. Yeah. I mean, depending on it, it's very slow, right? A lot of people are keeping themselves busy doing some lease work, but some of the larger, more sophisticated people, we're seeing deals starting to come in a little bit. So it's nice to see.
So speaking of deals, and we got a few minutes left here because I could talk to you for hours on this topic here because it's deals and trends we're going to talk about.
Yeah.
So before we hit record on the podcast here, I asked you what was the most recent transaction deal you said that you did. And you said it was a 1031 exchange. The down leg was a multifamily. Up leg was a retail center in Colorado Springs.
Right.
Can you kind of unpack the investor situation and just talk about the deal in general? Because, 1031s have slowed down a lot, obviously. And, I'm very unsophisticated in retail. Like retail is just very scary to me at the moment. Like,
sure.
Kind of talk to me about the deal, what the investors' goals were, and also how it worked out just in reality with the market and debt.
Right. So, and I think we spoke about this a little bit more too. Is like, once after you have been in multifamily for a little bit, like the next step is going to be retail, right? So we were working with an investor that owns various assets here in town. And he was selling out of a multifamily, and he had sold like a couple different deals that had taken for whatever, he'd taken a little bit longer. But so he'd sold that. Obviously you have the 180 days to identify and close. Looking for something, like you said, a little bit more stable, right?
And hands off, right?
And hands off.
More hands off, more
right,
passive.
Exactly, right,
Yeah.
exactly. And then the triple net retail space was great. His brokerage team did a great job of identifying an asset that was just totally complete, or that was, done being built. There was still some TI work being done. And so it was nice to actually have a lender that was okay with that because, we didn't have the tenants necessarily in the spaces.
Were leases signed though?
Leases were signed.
So leases were signed.
TI was being built out. But I mean, he had a time clock that we had to close on, right?
How close did you get to 180 days?
Like 10.
Okay.
I mean, it was right up against it. And so it was
added
like,
a few gray hairs there, huh?
I lost more hair. So, but no, we got it done. The lender was great. I mean, the borrower had some horsepower, which always makes things a lot easier to get done. But, I would say everybody was working towards the same goal, which made it nice. And so from the 1031 getting in there, even the developer that had finished the product was giving a few different concessions and paying some rents there so we could all get our heads around it.
What was the the cap rate he bought at, and then general LTV, just sort of like cap rate and just like lending terms?
So we got,
because this sounds like it's a turnkey triple net asset in Colorado Springs. Is that a 6% cap rate?
I want to say it was 6.25 cap.
Okay.
When we bought it, that actually might be high. I think it was maybe closer to 6. a 6 cap on that was where he was buying it. But like I said, it was brand new asset. Leases were, just signed. And some good leases too, right? So, I mean, there was a little bit of corporate that was back stuff there as well.
And they probably saw the multifamily at a 4.5 to 6 cap
right,
rate
yeah,
too,
exactly.
right?
Yeah.
Okay.
So.
And what was just general like loan terms, like LTV and interest rate?
So we had locked in our rate before things really got nasty, and good on the lender for keeping that locked and not retrading.
They honored
the
it?
deal. They honored it.
I've heard a lot of retrades.
They honored it for, and I would like to say that's more of me than it is them, but that's a different conversation for a different time. But I mean, pricing probably increased 175 basis points, and they locked it in for the whole time.
Wow.
And so he got some pretty amazing pricing, kind of closer maybe to where we are now as things kind of settle a little bit. But they stayed on it. So it was, 10-year deal, 25-year amortization, limited recourse. So there was like a burn down to it.
Okay.
So, once it gets to a certain debt service coverage ratio, then the personal recourse would kind of pulls back, which is nice. What was an interest only component? 60.
Okay.
60. So he had a couple bucks to put down in there.
Yeah.
So, triple net deal, 60% leverage in the Springs. Great lender, great borrower. It's fun to get it done.
Yeah.
Yeah.
Awesome. Well, how can people get in touch with you in terms of like to pick your brain? And obviously, like, you're in the trenches every day in the commercial debt space.
Mm-hmm.
Like kind of let people know how they can get a hold of you and kind of what your general, like, the space you play in. Is it a certain range, certain asset class? Like,
yeah.
Where's your superpower at?
From deal side, I would just say like historically, we've probably lived between like $1 and $12 million.
Okay.
Every kind of asset class, right, would be multifamily or retail or industrial, office, which is, funny, but self-storage. So we do a lot of work there for kind of the small balance, smaller mid-size investor group. As far as like, kind of getting a hold of, LinkedIn, telephone, email,
Yeah, we'll put your contact details down. Most people can get a hold of you. So
right.
Really just so people doing commercial deals about $1 to $15 million is kind of like the space
that we're in until,
in.
because there's, larger shops that really, get competitive for stuff larger than that. Not to say that we can't, but traditionally that's where our deal size has been.
That is what you answered my question.
Yeah.
Adam, this has been fun. I could talk to you a lot more about the trends in commercial space. We'll have you back on the show. We've also chatted about some webinars we might do together to go into more details. So appreciate you coming on here and look forward to doing more content and picking your brain on here. So Adam, thanks a lot, man.
Thanks, man. Appreciate you.